Okay, so if we go back to Pastor Dave's question, cash flow, what cash flow is trying to teach us is how efficiently are they managing cash coming in and cash going out. It's different from net income. What net income is saying is this company is selling this product. This is the cost associated with selling it. This is the profits that they keep, that, you know, that business makes. But there are some other money going in and out of the business, such as the depreciation, which is not necessarily an expense, but it was recorded in the net income, in your income statement as an expense. So that is added back. So that cash of depreciation stays in the business. It's money you can still use to run your business today. So that's what I want us to remember, that cash flow is simply trying to give us a feel for, do they have money to keep the business running? Because you can be making money from a net income point of view, but because of your other obligations, you may have problem within the next year or two. So cash flow helps us to understand if a company might be in that state. And one of the first things I explained to us last week is this last line, the free cash flow. We want to check that a company is not having consistently negative free cash flow. And remember the definition of free cash flow. It is, let me make this a little bit bigger. Free cash flow is the operating cash flow minus the capital expenditure. So the operating cash flow at the top level minus what, you know, is used for capital, making capital investment. So I guess the point I'm making is, if you're spending too much on capital expenditure, even though you are having positive operating cash flow, you may not have available cash flow, because once you tie money down in capex, it's not available for you to use to run your business. So it affects you. I'm just trying to make sure we understand the thought process behind cash flow. So Pastor Dave, your question was, will the let me be, I'm trying to remember the question. Will working capital affect cash flow? Is that the question?
Yes, sir.
Yes. So remember, working capital is current assets minus current liabilities. Let's go back to the definition sheet again. Working capital is current assets minus current liabilities. What that is saying is, within the next year, how much do you have in money at hand and money that is coming in, and how much do you owe people that is due within the next year? The difference is what you have available, you know, to run the business, from a working, buying things, paying for things point of view. Okay, so it does affect. We need to look at the working capital, you know, because if your liabilities are too high, then you will have a negative working capital. You might have a lot of cash at hand, but if those money is due to other people within the next year, you will have a negative working capital in that time frame. Does that help, or does that answer the question? Does that answer the question?
Oh, sorry, sir. I was trying to mute myself. Yes, it does. Thank you, sir.
All right.
Thank you, sir. Appreciate it.
No problem. So are we clear on this? The key thing I wanted to bring out here is, I wanted us to learn to kind of dig in a little bit. When you see changes in trend like we see, in fact, it happened to them 2017 to 2018, 2018 to 2019, before it turned around in 2020. I want us to learn to kind of dig in a little bit. What is changing and why is it changing? And we can just simply go in through the line item and see, for example, you know, they say operating gain, you know, so they had some losses here, but the biggest one here that is a big delta is the working capital that changed in the previous year. Their working capital went down by 15 million. This year, it went down by 79 million. The other year, it actually went up. Again, it's always kind of compare one versus the next. So the big change of 64 million here must have come from debts that it wasn't due the previous year. Now it's come due this year, this 2019. And that is why they have a significant negative impact on their operating cash flow compared with the previous year. Okay, so my key goal is just to make us to always think about when we see numbers going in a direction that we don't want it to go, let's try and dig into the numbers a little bit and see if we can figure out what's going on. And in this case, it's very obvious. It's the fact that the working capital is changing. And we then went and say, okay, what is the calculation of working capital? Essentially, it is current asset minus current liability. For this number to be increasing, that means the current liability is going up, in a negative way compared with the previous year. Okay. All right. Good conversation on the last assignment. Let's close that and go to our class for today. Today, we are going to be starting technical analysis as the main focus of the class. That's is the third portion of our overall training for the class. So we've done the review. We have quite a number of classes left. So today we're going to focus on the first two. We're going to cover two classes essentially today, if we can say it that way. Type of stocks and the first elements of charts or stock technical analysis. So when we say technical analysis, actually, let me go back to that Excel for a minute. I think when we say fundamental analysis, everybody knows what that implies now. That is using the financial statements to try and understand the company from a fundamental point of view. The conversation we were just having about cash flow is fundamental, is basic, is things that people ought to know about a business that you're buying, which is what you're doing when you invest in the company stock. You're buying part of a business. So you want to know how is the business running fundamentally. What do they do to make money? How well are they running the business? What should I look for from a cash flow point of view? Their assets, their liabilities, their debt, the current ratio, current asset, things like that. That's what fundamental analysis does. Technical analysis, on the other hand, is using the charts, the stock charts, to try to understand the business. There are people that what they do 24 hours a day, 7 days a week, is studying stock charts to make investment decisions. But for us, because we are not traders, we are investors, we are going to be using technical analysis as one of the tools to understand a company we should invest in and the best timing of our investment. One thing that the fundamental analysis doesn't give you is the understanding of timing. Timing to go in, timing possibly to set a stop, and I will explain that. Timing possibly to think of taking your profit. You don't see that from the fundamental analysis, but you see it from the technical analysis. So it's one of the tools in your toolbox. You don't use it by itself. You use it in conjunction with the fundamental analysis. Okay, so let's go back and look at it. Before I dive into it, I've asked that we all try and get some books. You can get the audio book or the hard copy and read these books. I strongly recommend them. I was remembering this book on the left, The Richest Man in Babylon. I read it many years ago, 2006. I was looking at the dates that I wrote. I bought it in Chicago in 2006. And it's it's not a big book, but it's a really good book. It's a gem, as they say. It's a very, very, very good book. You know, I strongly recommend it. I mean, it was written, I believe, around 1926 was when it was published originally. And I can read a few things there to make you think about what you will learn by going through it. Before I do that, is anybody waiting in the lobby? Okay. It told me someone is waiting in the lobby. So I think Tosin has helped to get the person in. You know, it says something like this. To the building of an estate, there must always be the beginning. That start may be a few pieces of gold or silver, which a man diverts from his earnings to his first investment. Those are kind of the things that we're saying, that just start slowly. Compound interest works with time. Initially, it seems as if it's not as valuable, but with time, you begin to see the power of it. He said to get his first start to building an estate is as good luck as can come to any man. With all men, the first step, which changes from men, which changes them from men who earn from their own labor to men who draw dividend from the earnings of their gold, is important. The first step is important. Those are the kind of things that got me kind of really thinking quite a bit about these things then. Says another point he made in this book, any man who will put away 1/10 of his earnings consistently and invest it wisely will surely create a valuable estate that will provide an income for him in the future and further guarantee safety for his family in case the gods call him to the world of darkness. Richest man in Babylon. Just a few quotes there. I like this one. It says, to the man who has gold, yet is not skilled, that is, has money, is not skilled in its handling, many uses for it appear most profitable. When you have money, but you're not skilled at using it, almost every opportunity looks like a good investment opportunity. Therefore, the inexperienced owner of gold, who trusts to his own judgment and invests it in businesses or purposes with which he is not familiar, too often finds his judgment imperfect and pays with his treasure for his inexperience. And the last one I will read, seek to associate yourself with men and enterprise whose success is established, that your treasures may earn liberally under their skillful use and be guided safely by their wisdom and experience. That is talking about not putting your money, investing your money in, businesses that don't have a track record of success. So those are some of the nuggets in this book, The Richest Man in Babylon. I strongly recommend that you read that book. Principles by Ray Dalio. Actually, I bought this, but I've not read it. I will read it after the book I'm reading right now. So I strongly recommend that we get this book. I've heard some very good things about it. Ray Dalio is the founder of one of the most successful index funds. And then The Intelligent Investor. This book, if you don't read any other book on investing, read this book. Intelligent Investor, Benjamin Graham. Benjamin Graham was the professor of Warren Buffett at the university when he was in college. And everything, Warren Buffett always says that everything that he learned about and knows about investing, he learned from Benjamin Graham. Very powerful book. And some of the concepts that I've taught us, one of it is the principle of the margin of safety, and which we will look at it a little bit tonight. He was the one that kind of brought that idea up. And the fourth one is Money, Master the Game by Tony Robbins. I think many people know Tony Robbins as a motivational speaker, but he's a very good author on many other subjects, one of it being finance. I strongly recommend these 4 books. It's going to take a while if you're, these days, I do more of audio book than the paper version. So maybe when I'm taking a walk, I just put it on and listen, and then I take notes on my iPad. As one key thing comes to my mind, I take a note and I can review it later. So those are recommended readings. All right, we'll start by looking at 3 classes or types of stocks. The first type of stock is what is referred to as a value stock. A value stock, essentially, I have talked about previously in one of our earlier classes. It's a stock that is trading below based on its performance, where it should be trading. That is a value stock. That's why it's called a value. There is value that is trading below its value, as it were. There's an opportunity to capture value if I invest in it. Excuse me, which is where the name comes from, value stock. If I invest in this stock, there is opportunity to capture some value. Okay, so a value stock is a security that is trading at a lower price than what the company's performance may otherwise indicate. If you look at the top right, there is a chart which I had shown us previously. It's even the logo that I put on our Money IQ WhatsApp page. So every stock has a book value, which every member of this class now can calculate at any point in time. I'm almost sure every one of us can calculate the book value. The book value, another name for it, is the intrinsic value, or the value, the true value of real assets that the company owns. Remember that when we're calculating the book value, we take out things like copyright and all those other type of things. So it's focused on real asset. That's why it's called the intrinsic or the book value. So every stock has a book value, which we can all calculate. For some reason, sometimes the value of the stock, the price of the stock, falls below that line, which represents its intrinsic or book value at any point in time. Sometimes that is driven by fear in the market, like what happened in March of 2020, this year. As I was looking at this, I went to open, I asked us to all do an assignment. I hope you did, which is to register for Morningstar, because we're going to be using Morningstar today. I went to look at United Airlines. If you look at United Airlines, I've not added here a line for the book value, but if you look at the way this stock is trading, it seems to have a range of price. This is on a 5-year time frame, between around $60 and around $90-something, where it's normally trading. But when the scare of COVID-19 came, that company stock fell down all the way down here to around a little over $20. You see that $20 here to around $20. In fact, a couple of times traded. You see where it says open. It traded at $19.72, even below $20 a couple of times. You know what most people do when this happens is they run away from the stock market. The stock is falling. It's like heaven is falling, so they run. Unfortunately, those are good investment opportunity. When you do that, this is why I was saying earlier on that we need to use technical analysis along the side of fundamental analysis and learn to look beyond the short term. Technical analysis sometimes is short-term driven, the way people look at it. But when you look at the financial statement and you're able to read it, evaluate it, and please take it into consideration in your decision making, it gives you a bigger picture. A company like this, why did it drop? Essentially because they felt people were no longer going to be flying for some time or whatever. So it dropped sharply. And those are kind of the things that drives a fall below a company's book value. When that happens, you find opportunities to buy. Let me put this back in presentation. When such thing happens, that is your buy signal. Unfortunately, that is when most people sell. What you want to do as an investor is begin to try and learn to identify those stocks that have potential value that is still capturable, but maybe the news or something going on in the economy. Sometimes it's the CEO of the company that maybe there's a news that came out concerning him, and it will drive the stock down, because a lot of people that partake in the stock market, they are people that all they're looking at is the price. They're not looking at the value. They are the ones driving the price on a daily basis based on news and all of that. So I want us as intelligent investors to be able to identify these kind of stocks that are trading below their intrinsic value, so that you can purchase here and wait for it to ride the waves and begin to turn around back towards its intrinsic value. So if you're a value investor, your goal is to identify this kind of stock and to sell once it gets back to its book value. Because beyond that, people are willing to pay a premium, and it's typically driven by not real fundamental analysis, but greed. So below the book value is driven by fear, above the book value is driven by greed. That does not mean you can't be successful trading above the book value, but you need to know at that point that it's not a value stock. That's the key message I want us to know. Okay, so a stock that is trading at this price versus its book value is a value stock, is the first point. The second type of stock is what is referred to as a growth stock. A growth stock is a company that, based on what we see about the business, has significant potential for growth in the future. A company that comes to my mind thinking about that is this company, Tesla. It's changed over time, but I remember when Tesla was selling around $60. That would have been a great opportunity for people to go in, because it was essentially changing the industry, the automobile industry. It was developing batteries that was not available before. There were other battery-driven cars, but the manufacturers of those companies, of those cars, are the GMs. So it was like a sideshow for them. They were not really spending money to develop the battery. But this company, Tesla, wanted to develop a battery that can run for many miles, many hours before, it fails. And it's the same technology that's in the phone. Forgotten the name of that kind of battery that essentially Tesla took and began to figure out how to make it last longer, drive further, and they started thinking about building a network of charging stations. So as an investor, you need to also listen to news. Listen to financial news, not from the point of view of pundits, as they say, the heaven is falling, get out of the market. No, but to try and understand companies that have some innovative ideas, some companies that are doing things newly. So I want us to learn to be doing that. It helps you to begin to find what are the companies, because there are so many organizations, many companies. But what you want are those companies that have significant potential, for growth, at least in the next couple of years, until some other technology comes or something else happens that might change that. Another one that comes to mind is like a company like Pfizer. Pfizer started when all this COVID thing started. They and a couple of companies started investing and in trying to find the vaccine. So a good investor should be aware of such news, paying attention to what's going on. And then they discovered the solution, and their vaccine is now, one of those that's going to be sold worldwide. So Imagine how many number of people are going to be vaccinated. You want to be one of those that make money from that kind of opportunity, you know. So those are growth stock companies with substantial growth potential based on something happening. It might be a small company that is, you know, doing something innovative, or even a big company that is well run. Those are growth companies. And then the third class are the income stocks, or also called dividend stocks. These are stocks of companies that have a track record of paying dividend. You should have each of these three different classes of stock in your portfolio. You should have value stocks, you should have growth stocks, and you should have income stocks. Income stocks is not necessarily, does not mean they cannot be growth stock. They can still be a growth stock. But generally speaking, most growth stocks don't pay dividend because they want to apply the money back into the business so that they can use that money to grow the business. Okay, so generally speaking, growth stock tend not to pay dividend. And dividend stocks could also be a growth stock. So I'm saying a company could cut across both sides, but there are some things that may not, you know, may not. That is, I think a growth stock more than likely will not pay dividend because they want to put the money back into the business to grow the business. Whereas a dividend stock, they will do their best to always pay dividend because most of their investors are people that want to earn dividend because they need that money for their daily life. Dividend not reinvested is cash that you can spend, you know, the moment you get it from the company. So there are a lot of retirees and people that, you know, need the money. It's like a fixed source of income for a lot of investors. So companies that pay dividend, they recognize that and they always do their best to make sure they pay dividend unless something seriously happens that stops them. Okay. So it's almost, in a sense, almost like a fixed income stock. I mean, companies like Walmart is a company that comes to mind when you talk about income stock. Walmart, for almost as long as I've known them, I can't remember when they did not pay dividend. You know, it's a dividend stock, and a lot of other companies are like that, like Procter and Gamble. You know, the solid companies that have been successful over the years. And rather than saying, okay, we want to put this money back into the business to grow the business, they want to take care of people that have invested in them, trusted their money to them over the years to give some money back to them. So they're always giving part of their income to shareholders. Okay, so those are three different classes of stocks that I want us to be able, as you're looking at stock charts, be able to think, what kind of company is this? Is it a dividend paying company? That is it an income? What kind of stock is this? Is it an income stock? Is it a value stock? Is it a growth stock? Because it will affect the way you're thinking about what you're looking at from a stock chart point of view. Okay, so this slide is what I call Introduction to Technical Analysis. Some very important terminologies that I will be chatting with us about tonight. It's very, very important that you kind of take note of them. It's going to be in the slide when you receive it. But, you know, I want to spend some time to kind of explain them. So right now, I'm inside the Morningstar site. And I've opened up XOM. Who can tell me which company is XOM?
ExxonMobil.
Thank you, ma'am. XOM is ExxonMobil. There are a couple of terminologies. The first thing let me actually open the actual site. Okay, I have United Airlines opened already, so I'll leave that open here for a while. Okay, I'll close it for now. So to get to that page where the chart pops up, all you need to do is maybe come over here. We're looking at ExxonMobil, so XOM. The name will come up, so we'll click on it. I'd like you to follow me as I do these things on your screen. When you click on it, you scroll down, and then there's this link that says show full chart. If you click on that, it brings up the full chart of ExxonMobil. By default, it defaults into the chart. You see this bar at the top here that says 1D, 5D, 15D, all the way to max. 1D means 1 day chart. So the chart that I'm looking at here, the stock chart, is the chart for this day. The market opens at 9:30 a.m. Eastern and closes at 3:30 p.m. Eastern. So it's the chart for 1 day. Yeah. If I click on the next, you see that the white changes to gray or dark, or black. So this chart that I'm looking at is for 5 days. So you can see from December 1 or so to today. Okay. And then so that's 5 working days, right? And then 15 days. Similarly, 1 month, and so on and so forth. You'll notice, I don't know if you noticed that as I changed it, because this was day, the frequency here was a smaller frequency. What that is saying is that the numbers that I'm scrolling through here is the number at every 5-minute interval. Okay, you see that it has this pop-up that is coming up as I'm going through. Is the number for every 5 minutes changes for over those 15-day period. If I change it to 1 month, the frequency changes to day because it says, you really probably don't want to look at minutes. But if you want to look at minutes, you just go up there and change it to minutes, and it changes. Okay, so this is every 30 minutes, 10 minutes, 15 minutes, 30 minutes, 60 minutes, daily and weekly chart. You can go on and on. Up to 10 years, after which you go to Max. Max brings up all the data for that company. Imagine if you invested in that company in 1973, even here, 1985, and then you partake in the growth of the company. So generally speaking, I personally speaking, tend to stay within 3. If I'm not looking at just the last year, I stay within 3 or 5 years. Mostly 3 years, because 10 years is too far for me to use from I want to invest today. What happened 10 years ago is too much of an history that is past that I don't really need. 5 years is also getting there, but from a context point of view, it's good to look at it. So this is where you decide the time range that you're looking at. If you look at the bottom here, there's like a window. You can also change the time that you're looking at by dragging this window to the left or to the right. Okay, so this chart up here is the same chart at the bottom here. I just use the window to decide on the time frame. If I bring it closer, it changes the time frame up here. The chart in the middle shows the volume based on the frequency I choose here. So the total volume bought and sold during the month of this month is March of 2020. You can see there the total volume, is I have to read it on the left there. It's about almost 1.8 billion stocks total volume sold for that company in that time frame. If I want to look at it more granularly, I change it to daily. Okay. So you can see that the bar charts are now much more, a lot of them. So this is every day within this time frame that I open with this window. So you can look at it more closely or expand it further out. Okay, I'll stay with the 3-year chart for a minute. I will keep this as the daily. I like to look at the daily because it gives you a much more, when we start looking at the indicators, it's much more helpful. Okay. So I've changed 2 things here. The time frame, I've shown us how to look at the time frame. Also here, we've seen the chart. Here is the volume bought or sold and sold during the day, every day. And up here, we see what is referred to as events and indicators. So if I click on this third one, earnings, what it does is it puts E on the chart. That is the date. On that day, the company announced its earnings report, made its earnings report to the public on those days. And you can begin to see on those days, is there some correlation between earnings and performance? At this point, they announced earnings and you see the stocks going up. So it must have been a positive performance earnings-wise on that day. Sometimes they will announce earnings and it will go down. Okay, so that's good to know. And then if I click on this one, if there were dividend paid in the time frame that I'm looking at, it will show me the days the dividends were paid. And those are shown in D. Then if I click on the simple moving average, what that does is it draws two lines. It says line 1 period 10, line 2 period 50. So one line, the line 1 is the 10-day moving average. That is over the last 10 days on a continual basis, the software is calculating the average stock price. So if the stock price is 10, 10, 9, 4, 8, 7, 7, over those 10 days, you sum it up divided by 10 is the average for that period. And then it calculates also the 50-day moving average. Okay, and it plots it. So if you want to close this event indicator, you just click back at the top here. If I click in the gray area, it will close the whole chart, which I don't want to do. Okay, so by simply walking through that, those indicators, I've plotted a couple of things on the stock chart of ExxonMobil. I've plotted the 50-day moving average because I selected the daily frequency here. So what is plotting for me is the 50-day moving average and the 10-day moving average. You see that? Okay. So that's all I want to show us. I will tell us a couple of things about what does that imply later. But I just want to show us what that does. All right, so we've seen a chart similar to this, which is really the chart of the same company, the 3-year chart of ExxonMobil. The only thing missing from here is I did not put those moving average. So I just have the charts without the moving average. So I'm doing that to explain some things. In the 3-year time frame that I'm looking at, something happened here, which everybody in this class knows as COVID. COVID caused people to panic and they sold. When there are more people selling than more people willing to buy something, what happens to the price of that thing?
It comes down.
Thank you. When there are more people selling than those that are willing to buy, it puts the power in the hand of the buyer. The buyer can say, oh, if you don't sell it for me at $5, I'll go to Mr. B because he's willing to sell for me at $3, at $4.50. And if the seller knows he wants to at least take some money, he's like, okay, go ahead, buy. I don't know if we realize it, but essentially the same thing is happening in the stock market on an ongoing basis, on a daily basis. People are bidding and people are, buying continuously. It's just as it's at a very fast pace with the advent of computers, but essentially that same process is going on. Okay. Now, what I would like to also point out here, when there are a lot of people panicking and selling, the stock fell. But before it fell, there is a range here where it seems that stocks tended to stay in terms of the stock price. Can we all see that? It seemed to stay between around $70 and a high of around $90. It never seemed to go above 90, at least in the 3-year period that I'm looking at. And for some reason, it never seemed to go below about $70. In technical analysis, that point where it seemed never to go below, unless something tragic like the COVID situation happens, is called the support. It's as if there is an imaginary thing there, table, that once the stock price bounces down and gets to that price, it will always go back up. And you see that quite a bit on this stock. For a long time, it never reached down to 70, but for whatever reason, when it reached 70 here, it bounced back up. It came down, it seemed as if it was going to 70, but it didn't get to. And then here, it touched 70, bounced back, 70, bounced back, 70, bounced back. That point of bounce back in technical analysis is called the support for the stock. Okay? It's an important thing to know, because if you can identify a stock support, what it tells you, unless something tragic happens, like what happened with COVID, that stock, if you can invest at that point, more than likely will go in the positive direction. So it's an important indicator to know. Then the other side of a support is what is called a resistance. Again, it's as if there's an invisible barrier that once the stock price gets that high, tends to push it back down and reject it from going higher. That is referred to as the resistance for the stock. And we can see the resistance on this stock. It seems as if at about this point of $80, something pushes it back. It might climb it a little bit and then no, it rejects it. Climb above, no. And then it starts tending to almost touch it, but never able to go beyond it. That is called the resistance for the stock. Those are important to know, because if you purchase at the resistance, it is possible that that stock might go down. Now, it doesn't mean it will always be so, because generally speaking, once a stock breaks through its resistance, there is a likelihood, if it stays above it, that it's not going to go back below the resistance. That becomes its new support, and then it starts going higher. The range is in that time frame of 3 years that we're looking at. The lowest it went before the fall in March was 70, which was its support, but it did go above its resistance to a high point of about 90. So the range is 70 to 90. That's the range, the price range of the stock. You'll normally find that they will tell you, when you're looking at a stock chart or a company's chart, they will quote the 52-week range. That is, what is the lowest price and the highest price within the last year. That's what the 52-week range is. When we're doing our analysis, I want you to go beyond the 52-week and always look at least 2 to 3 years, preferably the last 3 years, so you get a bigger picture of the company's performance in the medium term. Okay, so those are 3 things I've explained: range, resistance, and support. There is also recent highs and recent lows. You see the company fell here for known reasons for us now, and it fell and came all the way down to $32 from $70. But then it turned back up, and it came. I pulled this chart a couple of months back, so let's go and look at what it's like right now, actually. Okay, so this is the same chart, right? So it fell down to around 30 something here, 32. That was the recent low, because that was this year. So in the last couple of months. And the recent high is over here, which is $53, $52.88. So if I ask you what's the recent low for Exxon, that's the 32. The recent high is 54.55, and its current price is $40. Okay. If I go back to our presentation, another thing I'd like you to be aware of is what analysts evaluate the stock performance to be. But before I look at that, actually, I'll come back to that. I'll continue for now. So if you go into this popular Yahoo page, on the right frame, it has some useful information. It has the earnings. I think I've explained this section to us before, so I won't spend time on it. It shows as a chart the financials, the revenue and the earnings, which we all know where those numbers come from now. That is from your income statement. And analysts begin to evaluate the stock. Analysts are very important and powerful people when it comes to stocks performance, because they are the ones that the companies report to. Securities and Exchange Commission expects that every publicly quoted company quarterly reports their performance, financially speaking, to the market. And the people that listen, everyone is open to listen, is open to everyone. In fact, shareholders of the companies, if you own the shares of the company, they will send a letter to you to say, look, we have a analyst meeting on such and such a date, participate, or a shareholders meeting, whatever, they will inform you. But the people that are always in those meetings are the analysts. They are people that kind of look at the companies, look at their financial performance. There are people, most of them are MBA type people that work in the different fund management companies, Morgan Stanley, Charles Schwab, all these different investment related companies. And they will report to them. And those analysts, based on their knowledge and their ability to evaluate, the information that they get from the company, can make projections for a stock if you should buy or sell. I generally don't want any of us to make any decision based on looking at that. I don't use it to make investment decision. But one section of it that I think is useful is this analyst price target. And what this section does is, number one, it tells you how many analysts are following ExxonMobil. There are 22 analysts following them. And those 22 analysts have evaluated Exxon's performance and said, look, the low we expect this company's price to be is $30 based on what we know today. We expect it to rise to $74 sometime soon. On the average, based on those 22 people, they all average the price as $43.77. And this chart also tells you the current price, which is $40.90, like we saw over here, $40.90. Okay, so this is an important or useful information to know when you're doing your analysis. In the table that I shared with us, I think we all remember that table. I shared a spreadsheet with us that you use for analyzing your investment. One of the numbers that I asked that you put in there is the average price targets. When I'm doing an investment analysis, it's also one of the numbers that I evaluate to see how does my own projection compare with what analysts are saying about the company. Okay, so analyst price target is another useful information. For ExxonMobil, we saw that price target is $40. I think it was $43 just now. So if I was going to plot that $43.77, if I was going to plot that here, it's somewhere down here, is what the target average. The high said it's 74, the low said 730. So you can plot those three And you can see how that relates to where the stock price is at the moment. Then target price. Now, when you're making an investment, if you are able to invest in a stock that is a value stock, what is your target price from what I've explained? I've explained it before, and I've also said it today. If you are investing in a stock and you've done your analysis and the stock is a value stock, so what I would ask you to tell me is, first of all, when you say it's a value stock, what are you looking for? And then what is my target price for a value stock? Who can help us answer that question?
You are looking for a stock that is selling below the book value.
Thank you. Thank you. Thank you. Thank you. Again, sometimes I ask this question to kind of reinforce what we've talked about, and I'm glad we all remember the answer. Okay, so the stock is trading below its book value. In that case, what is my target price? If I'm investing in a value stock as a value investor, what would be my target price? Remember, I don't think I've explained that. The target price is the price I would like to sell it at. Don't forget that we are long-term investors, so I'm not necessarily saying I will sell at that point, but I'm targeting that if my stock gets to that point, at least I'm ready to sell if I wanted to, okay? Because I've achieved my objective. I can leave it and let it continue to rise, and there are some things I will explain in that respect later, but at least I will have achieved my goal. What is that goal for a value stock?
Would that be when it gets close to the level of resistance, close to...
No, I'm talking about
beyond the support level.
In general, no. So think about what I have explained. I'm talking about just the value stock now. That's the value stock.
So your question is, what should be the target price?
Yes.
Of the value.
When it gets to resistance, is it resistance?
Not really.
Not really.
It's when it gets to that support level.
No. Again, I'm talking about a value stock. That's the key word. I have the chart even at the bottom here. I have the chart at the bottom here.
It's target price for value stock is the book value.
Thank you. Thank you, bro.
I thought Iyabeji said that.
I said it too.
She said resistance.
That was the first thing I said. Then when you now mentioned value, I said that would be the book value.
Book value, yeah.
Okay, I didn't hear that. But book value is the target price for a value stock. It's very important that we keep that in mind, because what you're doing, sorry, give me a minute, please. There's some noise here. Okay. So what you're doing when you're investing in a value stock, which we see in this chart that I've been using to explain this. This is Benjamin Graham's chart. So you go in and you buy here, and you wait, you ride the wave until it gets back to its book value. At that point, you have made the money that you wanted to make between when you bought and now. That's why it's your target price.
So is that the best time to sell?
It is, if you are investing strictly as a value investment.
Okay.
It doesn't mean you should sell. It doesn't mean you must sell. But if you're investing in it strictly as a value investment, that is the point that you should be ready or willing to sell, because you've made your profit.
Okay.
Okay. And I will explain some more things as we go along in these sections of the class. Actually, I have it here, so I have an opportunity to talk about it when I come to stop loss. Okay, so for a value stock, that is the price. However, not all stocks are value stock. Remember what we explained. A value stock is trading below its book value. But it does not mean unless all you want to do is value investing, then that means you will never buy a stock that is trading above its book value. Okay? Which is not necessarily practical. You will have some stocks that are trading above their book value, but still has good potential because they are growth stocks or because they are dividend stocks. Does that make sense?
Yes.
Yes.
So when you've done your analysis using that spreadsheet that I gave us, that template of book value, you've done your analysis and you know it's not a value stock. But every other analysis that you did shows you that this is still a good investment opportunity. For example, ExxonMobil. ExxonMobil fell at this point, which its resistance, its support was $70. It fell below its support all the way to 32. Now, I've not done the analysis and I don't know if 32 is makes it a value stock. I don't know that for a fact. We can do that. I think everybody in the class can do that now. However, there is value in purchasing the stock. Why? Because we know that this stock is trading below its support. Any good stock trading below its support is going to rise back to its support level. If you go back historically and look at, in fact, if you remember the chart that I showed us that shows the long-term performance over 140 years, there will be times that the stocks will trade below, their normal trading price, which may not necessarily be the book value, it's just its trading price, which in this case is the 70 to 90 range. Okay, but it will always rise back to that line and then continue along that trend. Historically, that is expected. Because there are a lot of people that are buying and selling shares. And most of those individuals that are doing so are not looking at investing based on what you and I as investors are looking at. They are simply looking at this chart. They are technical investors. They are seeing this chart and they say, look, this chart, this stock is currently trading at $44, but its support is $70. So they go in big time and put a lot of money into it. At that point, there is more buyers bidding for the stock than sellers. What do you expect to happen when that happens?
Price will go up.
Thank you. It's like any market. It's amazing how the stock market, that's what they call efficient market theory, in business. It's amazing how efficient the market is. It will always reflect this performance that I'm telling you. It's simple demand and supply, period. Because when people see this price, this stock is trading, and that is why it didn't fall below 32. Because once it gets that low, and see how quickly it reacted, it responded, you see this sharp bend, it's because people saw a bargain. A lot of people saw an opportunity to buy. And that is when to buy. Most people run away from the market when they see this. When I see this, that's when I want to run in and buy stocks. Well, that is when most people are running away. I just wait for it to reach about this bouncing spot, which it happens in like a day or two. I'm not talking about weeks, because by weeks it's already turned around. So when you hear a news that negatively pushes a stock down like that, you need to go in and try and see if there is an opportunity for you to invest in that stock. If it's an investable stock, after you've done your other fundamental analysis, then you go in. You may not necessarily be able to catch it at the bottom here, but riding it somewhere, anywhere here is still good because you see where it's going to run back to. So in this case, let's say you bought it around $44. You couldn't catch it here. It's risen $12, and then you purchase it here. your target is no longer, because we're not talking about value stock now. You're talking about, maybe a growth stock or a dividend stock, right? A solid company, like I've explained earlier. You know it's going to rise back towards its support. So your target price becomes the resistance. Maybe this is what Mr. Bola was talking about here. The small resistance you see here, the short-term resistance you see here, becomes about where you target it, above your support. Okay, so your buy price is 44, your sell price is slightly over your support or even your support. So you're saying I'm buying for 44, I'm selling for 74, thereabout. I'm making $30 per share. That's a way to invest. I mean, there are people that is all they do when it comes to investing. Another thing that you could do when you find such an investment opportunity, and I do this, is if I'm going to invest in this company, because I know it has a resistance above 80, I don't want to wait for it to hit the resistance, because more than likely it's going to tend back down once it hits the resistance. So once it goes above my support, I will set what they call a stop. And the software that you use, your broker use, has that capability. What it does is such a powerful tool. It allows you to lock in that profit, so that even if you're sleeping and the stock happens for whatever reason to fall from 75 down to where you set at your support, let's say in this case 74, and you have locked in $30 per share, at that point, even if you're sleeping, the machine will sell that stock for you and keep the money back into your account. So it's a way to protect your downside and keep your money. More than likely, any stock that behaves like this, if it's an income stock, you've evaluated it, or a growth stock, we talk about value. The value one is slightly different. It's going to rise back to its book value. But a growth stock or an income stock will definitely, without doubt, historically rise back at least to its support. More than likely actually rise above its support, at which point you then set a stop. And your profit at your stop will be, in this case, if your target is, so you see why it's important to be able to read the chart and be able to say, okay, this is my support. So I'm setting a target that is slightly above the support. And then I'll set a stop at the support or something like that. If it rises towards the resistance, it more than likely will trend back down. It doesn't mean I should sell, but at least I've already set a stop. Does that make sense? I'm locking my profit. I want to pause a little bit and be sure everyone understands this explanation here. This is very, very important.
So how do you do that? How do you lock in your profits?
You set the stop. That's what I was
Oh,
saying.
you sell it.
Yeah.
Okay.
You don't sell it.
Oh.
You stop. It's called a stop loss.
Oh, okay.
So the software, let's say you open an account with Charles Schwab, and then you have this stock and you bought it at $44. Okay. You already did your technical analysis. You know that the support is 70. And your target, based on your evaluation, you see that around 74, it seems to be trending back down, at least even shortly before it went. The resistance is still way high. So you decide, look, once it gets to like 77, 78, before it hits the resistance, I want to lock in my profit. So I keep my principal and the profit as I've made as mine, even if something happens that brings it down. You go into your account, you click on that stock, and once you open your account, I don't want to open my account to show you. Once you open your account, I can show you how to do that. You click on that stock, you set a stop. Then you put the stop number. So at that point, maybe it's already trading at $78, right? And maybe it's going to even rise to $100. Who knows? But you just tell them, I don't want to be, in the stock if it falls back below 74. So the software knows, the machine then, keeps that information, and on a daily basis, it keeps selling. Your stock price value keeps rising if it doesn't fall. But if it falls, even if you are sleeping when it does, the machine will sell it for you and give you both your principal and your profit. So imagine if I had bought 1,000 shares at $44, and I waited, I let it rose, and it became $78. My shares is now worth 7,800, and I invested 4,400. So my profit of $30 per share, actually at that point, is 78 minus 44 is about 4,400 or so dollars per share, right?
So, yeah. So when he sells it for you like that, does he put the profit in your account and leave your
account? It stays in your account.
Okay.
It stays in your account, and then you can take that. You invested 4,400. Now you have 7,400. You made a profit of $30 per share, which is $3,000. Okay. You can, choose to reinvest it in another company that you've analyzed. There are different things that you can do in that respect. I'm just trying to help you understand that, this behavior of stocks is good to, understand. I was showing us at the beginning United Airlines. Let's go and look at that. No, this is on the hammer, sorry. Let's see. Let's stick with the one that I wanted to show. UAL, United Airlines. Why is it not coming up? Okay. United Airlines. United Airlines and most other airlines was hit badly by the COVID-19 situation. If I look at it on a daily basis, look at where United Airlines resistance is. Who can tell me what the resistance is for United?
94. Oh no, 90.
Go say it again.
94. No, 97.
Thank you. About 90. On a 5-year scale, it's about $97.
Yeah.
You can see. Remember what I said on the resistance? It's as if something there keeps pushing it back, right? So more than likely, it's not going to go above 97. It doesn't mean it will never do so. In fact, look at it broke the resistance here. The old resistance here from about 5 years ago was 58. And generally speaking, once the stock breaks through its resistance, it's going to go higher. And that resistance tends to become its support further down. See, it broke the resistance it had here, and it rose and established a new resistance around here, around 75. And if you look down here, look at the new support. I don't know if you all can see what I'm seeing here.
Yeah.
That line that is showing the dotted line, if you look at it from where I have the chart popping up, the pop-off showing the date popping up, if you look at it towards the right, it seems as if down the line, that has become now the new support for the new price level. Can you see that? I don't know if you can see that. The only reason I couldn't see this point.
Okay.
See, it becomes as if once it gets lower to that point, it bounces back up.
Yeah.
See how close that is to what used to be its resistance
Yeah.
in 2016. See what I'm saying? Because the people buying this stock, most of those day trading, they are only trading off of chart, period. They are not trading from the analysis that I've taught us. So they are looking at this and saying, oh, this stock is already, okay, it's not going to go lower than this, whatever. And that's how they are buying. And that you can use to your own advantage because you know that that is their driver. And then, again, it broke through this resistance that it has here and started going back up, and established a new resistance at $98, 97, almost $98. Can you see all the points at the top here that is all bouncing back at 98? Can you see that?
Yes.
There's a new resistance. And at that point, it has established a new support. You see the new support?
Mm.
The new support is about 80, let's say $88.
Yeah.
Exactly. And the new resistance is like 90,
Mm.
about 95, 90, yeah, around $95. So that stock will have always traded between 84 and 95, between about 80 and 95. That's where it will have traded up and down until something moves it. What moves it to break its resistance? A good performance.
Mm.
They did so well one year and they reported their earnings, they reported good net income. Everybody will rush in and say, hey, this company is going to do well. And it breaks through that resistance. And it's going to continue going up until something else happens that pushes it down. Then it's going to always trade between those lines. If I copy this and put it on the PowerPoint for you, in fact, the trading platform allows you to draw things on the chart. You know, this is not a proper trading platform, so I can't really draw much on it. I'm just using it. Let's say actually maybe I can draw. No, it doesn't allow me to draw. Let me do something. Level line. Maybe that will work. Yeah, excellent. That worked. Excellent. This is what I was trying to draw. Let's see if you let me pull that down. Yeah. See the resistance? Excellent. I've never used this for this. I used other application to do that. You can see the resistance at 95 and the support at 76. Can you see how it keeps bouncing back?
Yes.
Yes.
That is your support. Similarly, the resistance is going to keep pushing. If it slightly crosses the resistance and it doesn't have a good reason for crossing, it's going to go back down. And it will always do that, or maybe slightly get close to it, or then it goes back down. These two numbers are very important to know, because when you are investing based on a fall like this, and you have the opportunity of coming in anywhere here, it's important to be able to say, look, if I invested at this point, let me draw another line there, level line. Let's say I came in here, somewhere here. Okay, I bought it at $30, $29. My goal would be for it to rise back to above the resistance at 76. How much will I have made by that investment per share?
78 minus 10, that's like $48 per share.
Yeah, almost 40, about 48. Let's say $48 per share. That is significant investment opportunity, brethren. I'm not day trading. I don't even need to have any heartache. You know, I don't need to worry, will I lose this money? You're not going to lose the money. Because the only reason it came here, down here, is just news that does not change the true value of the business. Where's United Airlines going? United Airlines is the third largest airline in the world. And on top of that, before you make that decision, you've looked at their financials. Remember, you are an investor, you're not a trader, right? You've looked at their financials. You've evaluated and said, oh, this company, based on what I'm seeing here, their free cash flow is good, but at least before this year when they had a problem. Once the problem turns around, this company is, and I did this, to be actually honest with you, I did this for United and we made good return on that investment. In fact, we have sold to recover our principal, and the money that we have in United today is the profit that money had made.
I need to become a millionaire.
So you see what I'm trying to say. So today United is selling, we bought it around somewhere there and it's selling around $50 here. When we sold to recover our principal, it was selling around $40. So we recovered the principal, kept enough just to cover the profit, to be just the profit that remains in that stock. So even if it goes to zero, I've not lost anything. Because it's money that I didn't have before. But I know it's not going to even go to zero because it's still trading below its support. I know beyond a reasonable doubt, if I was in the court, I would be arguing like that, beyond a reasonable doubt, that this stock is going to rise back to the support, without a doubt. Look at that's where it's trading. This is between the date here is 2018 July to when it fell in 2020. That's about 1.5 years, or February. Yeah, about 1.5 years. So what will make it not go back there? In fact, if it wasn't for what happened here, what will have happened was it eventually have broken through its resistance and gone higher. But at least for 1.5 years, you see it between the range of 76 and 95, which was the support and the resistance. So I'm teaching us this so that you can use this as a tool along with your technical analysis. And when people are running, you are actually seeing opportunities for investment. You know, this is what a lot of Israelis do. And we are spiritual Israelites. A lot of people don't realize this, but a lot of Israelis, Jews, this is when many people are running out of the market like this, they say the stock is on sale. And then they rush in and buy a bunch of this, invest millions. Imagine if you were able to invest 1 million here, you know, or buy 1 million stock here at $29, that's 29 million if you had the money. And that by the time you sell it, you're making 76, 77 million. You just left with that, with 50 million or something. And how long? The time it went down here was February, was March. We are now in December, so that's about 7 months. And if you bought it and you invested, you know, that 29 million is now worth 50 million. So you've made 21 million in 7 months. Let's say we're not even talking million. Let's just talk thousand. 1,000 stocks, yeah. You invested 29,000. Now it's worth 50,000. So you made 21,000. Let's not even talk thousand. Let's just talk 100. I don't have enough money for 29,000. So I buy 100 stocks here and I invested $2,900. Today is selling for $5,000. So how much have I made? $2,100. That's money that if you put it in, my daughter and I were chatting about this over the weekend. We're looking at her financials. She has all the different accounts like I've asked us to open. She has a checking account. She has a savings account. She has a 401k. She has an investing account. She has, what's the fifth one? Checking, savings, investing, 401k. There's a fifth one I can't remember right now. So we're looking at savings account, and she was talking about a stock that she purchased and some money she has in the money market. The difference in the value that the money market and the stock has given her in just a couple of months versus what she has in the savings. Savings, they will pay you like 0.1% or something like that. As far as I'm concerned, I tell people, when you put money in savings, know that you are not investing. Yeah. It's savings. You need that money. You are trying to put it together, maybe to buy a car, to fix your car if it breaks, things like that. That is what savings is. It's not investment because it's always losing money. Yeah. You are always losing money in savings, especially in this part of the world. Let's say they even give you 1%, which is very unlikely that they will give you. The inflation rate is 3%. So every year you are losing in real value 2% of that money. Whereas in just about 6 months, look at the turnaround. And there is no way this is going to, especially with COVID, what's it called now? Immunization thing. Vaccine, thank you. With the COVID vaccine, people are feeling more comfortable to travel. They feel it's going to be safer. So it's going to take time to respond. No doubt about that. And that is why you need to be patient. You're not a trader. You need to wait for it, and I can, within good reason, expect it to get back, because that is where it is, to its support. And once it gets back above 76, then don't be greedy, because you know why you bought. Also, that when it hits the resistance, the likelihood is that it's just going to go up and down in that range. Now you can take your money and go look for another opportunity like that. So once it gets to, let's say, 80, which is kind of my target for this particular investment, for what I have left in it, I will set a stop at, I always give it room, because people are always buying and selling. And if you set it too close, it's going to stop and give you back your money. I mean, you still have made your profit, but why take the money if there's still room for it to grow? So I will let it get to like around midway between 76 and 96, which is like 81. When it gets to 81, I'll set a stop at my support, because it's likely not going to fall below that point. And if something happens and it decides to fall below, give me my money, and I'll go invest it somewhere else. So once it gets to 81, which is my strategy on this stock, I'll set a stop at 76, slightly below the support. I know there's a tendency for it to rise towards the resistance and come back down towards the support, but more than likely it will not stop me out, because I set my stop slightly below the support. I've already met my profit target. It might take a year to get there. It might take, it depends on why it was that low in the first place, right? And then once it gets there, if for whatever reason it chooses to break its resistance, which is not impossible, I stay in the market and it keeps going. And then I can lift my stop a little bit and lock in a little bit more profit, and so on and so forth. So that's the power of technical analysis. It gives you the element of time which you don't see from fundamental analysis. Okay. Any question on that? What I thought AI is so powerful, this is what some people do, 8 hours a day, 7 days a week. What I just showed you here. Of course, there's more to it, and we will look at some of those more to it as we go through this technical analysis. But there's a lot of potential investment opportunities like this. If you listen to the news, understand value versus dividend versus growth, the stocks that if it's a value stock, you're not using that resistance, you're using its book value to decide on your target. But if it's a growth or dividend stock, then it is the resistance and the support that becomes the tool that you use to see, okay, what is my goal? What's my target? It might take a year to get there. It might take 6 months. It might take 2 years. At least you lock in your profit, somewhere slightly below its support, and then more than likely to keep going up. And, as long as you maintain a long-term view, you're not going to lose money. I mean, all the stocks, they will always have support, they will always have resistance. Your goal is to be able to identify, and I just showed us how to draw the chart. I didn't even know that this Morningstar has, the line chart. There are other, softwares that can even help you to draw other things, but at least these are, the level line is very useful. Let's see, trend line. Yeah, trend line is another good one. See, you can put a trend on it. You can remove it. Yeah, I don't know how to. Those that are proper trending softwares, okay, it's much more flexible to use for drawing lines and putting things like that. But at least you see how this is. Actually, I will capture this and even include it on my slides. Very useful.
So, hello, sir.
Yes.
So how did we, get to this point from the Morningstar?
All right, let's go back. Let me just capture this screenshot for a minute. Actually, we can redo it, so no problem. So have you gotten into your, are you in your Morningstar account?
Yes.
Okay, let's type, we're working on ExxonMobil. So go ahead and type XOM. Okay.
Yeah.
And click on that once it comes up. It's a little bit funny because it's at the bottom, slightly at the bottom. So you scroll down slightly, and then you see this link that says show full chart.
Oh.
Do you find it?
Okay, so ExxonMobil Corporation. It doesn't look like I'm seeing what you are saying. So ExxonMobil.
Scroll down. There's. I can do it again.
There are a lot. Okay, so if you type, let's do it again.
Let's just start by going to that earlier page. So this is what comes up when you just logged in.
Yes, exactly.
Okay, let me try and see if I can go back to home. That's the important question is asking. Everyone should be following my steps here. This is what comes up when you just logged in, right?
Yes.
Exactly. See this section that says search codes and site?
Yes.
Okay, let's go in there and type ExxonMobil, XOM. Let me know once you've done that, and then you click on ExxonMobil Corp.
Yes.
Okay. When you click on it, the chart is kind of towards the bottom, and you may need to scroll down to see, depending on your screen resolution and screen size.
So when I click, it brings a list of different ExxonMobil corporations. Not like it doesn't go to it directly as you have.
Okay, let's try that again. So when you're here, you typed
XOM.
You see, because it has a number of companies that are similar to that. So it's going to give you a couple of things. You have to click on the one you want.
Yes.
So did you click on this one?
Yes.
Okay.
Okay. So that's now it's taking me to that page.
Yes. So you are on this place that I'm at, right?
Yes.
Okay, now see this link that says show full chart.
Yes, I click that.
Click on it, and then it will bring that chart up. Is that helpful?
Yes. Oh, very well. Thank you.
So let's do the same thing that we've done. Just click on the 5-year chart. 3 year, let's do 3 years. I always use 3 years. 5 years is too long for me to take a decision on. So 3 years. And the next thing I want to do is I want to put some indicators here. I put earnings and dividends. I see that at the bottom here. And then I want to also, actually that's enough for now for what we're doing for today. And then I want to put a drawing. So click on drawing and click on level line. When you do that, try and see where is your support for this stock, which is where I just placed it. And look for your resistance. Your resistance is about here. See the same signature that we saw in United Airlines? It's bouncing between 67 and 83. That's the support and the resistance for this stock over the 3-year range that we're looking at. Currently, it's gone down. And if I was investigating and trying to buy, Ideally, you want to kind of wait for it to turn around. So it's turned around, and generally speaking, you may not be there when it's that high. It came back down here, so it gives you another investment opportunity down here. So let's say you choose to buy down here. So let's put another line, and you purchase it over here. You purchase it and it went down a little bit, but you know, that's your sub purchase point. So at that point is from this point where you bought at $35.80, it's now selling at $41.68. And you're going to wait for it to rise. It's going to take some time to rise back to its support. When it goes above its support, you divide between your support and resistance, you have about 6 points, $6. And when it rises down up to this point, I'll draw another line there. When it rises to the middle of the two, which is, you know, your goal, you then set a stop slightly below your support. Let's say at $67 or $67.50. So it's likely going to bounce up and down in this window and not come down and kick you out, right? But if it does for whatever reason, then you keep your all the profits that you made down here. It remains yours. Does that help?
Very well, sir.
So that's where we'll end the class tonight. I covered range, resistance, support, highs and lows, analyst price target, the target price, and I explained that for a value stock, that is your book value. On the other hand, when you're looking at what we've been explaining, a stock that is not necessarily a value stock, but maybe a growth stock or a dividend stock, you need to establish your target price as between your support and your resistance, preferably about midway between the two becomes your target price. And once you get to your target price, you can set a stop slightly below your support. We talked about the goal profits, which is essentially if I'm buying here and I'm selling at my target, what's my profit? I talked about your stop and the profit at stop. So if I get knocked out at the stop, what is my profit? It's the difference between my buying price and your support, which is where you set your stop. You see that there is there's always risk in any investment, but the likelihood that you're going to lose your money is very low. Mm-hmm. It's very low. I mean, demand and supply will pull it back to its support, period. So you want to be looking for these opportunities by listening to investment news, listening to things that you know might impact. That's why you might see me listening to CNBC or business channels, other business channels and things like that, like Bloomberg. Because I'm not listening to it and watching the tickers for, the price. No, I'm listening for ideas. And then I'll go in and do my analysis. If my analysis supports an investment decision, well, go ahead. That means you need to have your money set apart so that when this opportunity comes, you are able to take advantage of it. Next week, we will look at in other indicators. We can't finish it in one class, but we're going to look at, I already showed us volume today, but we'll look at it a little bit. We'll look at RSI, Relative Strength Index, price to book value. I think we all know how to calculate that now, but how does it play into technical analysis? We'll look at that. The simple moving average, we talked about it briefly, but we'll look at it in more detail. We'll look at MACD, moving average convergence and divergence. We'll look at momentum. We'll look at short sale, and we'll look at short interest. Those are the indicators that are very powerful that we can use along with what I taught us today. That's where we'll end tonight. Any question about what we've learned today? Okay, so everybody in the class today should have a better feel about kind of understanding stock entry points and potential exit points, how to determine those points, because that's a question I have people ask, how do I know when to sell? By understanding essentially what we talked about today. It's pretty, powerful what we talked about today. That is, a good way of evaluating entry and exits. Again, I'm not saying entry and exit on a day-to-day basis, but from an investor's point of view. All right. If no question, we can switch back to our videos, and we can switch on your videos, and you can ask me anything before we close regarding our class today. Thanks for attending.
Thank you very much, sir.
Thank you very much.
Thank you.
Thank you.
You're very welcome.
I'm going to become a millionaire now.
Amen.
Me too.
Amen.
Amen.
God, all things are possible.
Yeah, amen.
Yeah.
We will all become a millionaire and millionaires.
Amen.
In Jesus' name.
In Jesus' name.
Pastor Dave, good evening.
Good evening, sir.
Yeah.
Good evening, sir. God bless you, sir. Thank you for all you do.
This
Amen.
is very cool.
Yeah. Very more anointing, oh my brother.
Amen.
In Jesus' name.
This is really, really.
Amen.
Hey, Shay.
Well,
Amen.
Amen.
So what we cover today is very useful when it comes to, like I said, identifying entries and exits. So keep it in mind. What we cover over the next couple of classes is going to solidify what we started and we then run these classes. All right, if no question, we'll end here. Have a nice evening. I'll send the slides. And there is an assignment actually. I'm having some
you're
echo.
echoing a little
Please,
bit.
can you mute your phone for your computer for a minute? There's an assignment which I'll send out to Ross. I'll send it. It's actually a simple assignment. It's just for you to look at some charts. But let's see if I can find it quickly. Yeah, don't worry about it. Don't worry about it. I'll look for it and get it across to Ross, and you can do some practice with it. It's going to cover what we looked at today. Okay, so for today we've covered two classes really. We've covered stock types, we've covered stock chart analysis section 1, and we covered all the elements of it. Okay. I think I sent the templates that will be used for this already to Ross.
Daddy?
thank you, sir.
You're welcome. Yes. Damilola?
I just wanted to let you know, Madeline thinks that this is really cool, and I think she wanted to get that point across.
Oh, good. I'm glad you were there. Madeline, how are you?
She wasn't here the whole time, but like.
I'm doing good. This is
Good. I'm glad you attended a little bit of that.
Yeah, I'm gonna help teach her what I've learned. Yeah. So I just wanted to let you know.
Excellent. Excellent. That's good. I'm glad you learned some things there too.
Yeah.
Good. Good. All right, everyone. Have a nice evening. I'll send the slides and homework. It's very simple. You can do the homework. It's very simple.
Thank you, sir. God bless you.
Good evening.
Have a nice evening.
All right, thank you.
Thank you, sir. God bless you, sir. Bye.
Amen.
All right, bye.
Bye.
Bye-bye.